Welcome to the Retire with Peace podcast, the podcast where we help you create a fulfilling and stress-free retirement. Each week, we bring you expert advice, practical tips, and inspiring stories to help you plan and live your best retirement life. Whether you're nearing retirement or already enjoying your golden years, this podcast is here to support you every step of the way. Let's embark on this journey together and discover how to retire with peace.
Welcome back to the Retire with Peace podcast. As always, I'm your host, Dave Zaegel. Today's episode is again brought to you by CWOs for Hire, which is the retirement planning firm that I co-own, where we help retirees and soon-to-be retirees navigate their retirement, get the most out of their money, save money in taxes for sure, and just overall be comfortable with their planning and be able to retire with peace. Today is a bonus episode on evaluating investments, especially investments in stocks of publicly traded companies. We had done 3 previous episodes that talk about management, cash flow, balance sheets, but this bonus episode at first might seem like a no-brainer. It might feel like something that is not that big of a deal. Everybody should be able to do it. And true, probably everybody should be able to do it, but not everybody does it. And that is really simply understand what the company does. Again, sounds so simple. Sounds like, of course, I'm going to know what the company does. That's why I want to invest in it. I get it. But here's the challenge is that oftentimes I find when I talk with people about different companies, different investments, they have a view of what the company does and how it makes money, but it doesn't necessarily match with reality in terms of what the company does and how they actually generate a profit or how they are growing. Let's take a couple of examples. Let's look first at Disney. Long been a good company. As an investment, it's struggled in the recent history, but over the several decades, great company. A lot of people will think of Disney in different ways. Some might think of it in terms of the parks. Some might think in terms of the movies. Some might think of it in terms of the streaming service they have, or some combination of all of the above. They're all fine things. Those are what the company does. But if we look underneath, and if we listen to the earnings calls, which is important, if we listen to the company and we really look at the cash flow and the balance sheet and the income statement and where they are making money, we find some really interesting things. For example, with Disney, for a long time now, the majority might not be the right word, but a substantial portion of their profits have come from ESPN. Now, some people know that they own ESPN, some don't. It's part of the ABC network that they bought a long time ago. But a lot of their profits, really their cash cow, their machine, was the cash and profits generated from ESPN. That's not to say that the rest of the company was bad, but if you really dug in and understand what drives the company for a long time, it was ESPN's profits. And what they've experienced over many years now is a decline in profits from ESPN. So while the other parts of the business exist, oftentimes people are scratching their heads going, well, they're coming out with all this awesome content and movies and they're expanding here and there. Why isn't the stock going anywhere? Well, their biggest profit generator is actually declining. So it's important just to understand what's driving the company. And if you can't really do that without really digging into the financial statements, at least a little bit, and also listening to the conference calls where they talk about different segments generally. Now, some companies don't break out segments as well as others, but oftentimes you can get enough detail to understand what's truly driving the company. Now, another great example of this is Apple. Oftentimes, well, not oftentimes, but let's dial the clock back a bit, probably a little over a decade ago. If we look at when Apple was trading really, really low price to earnings multiples in the low teens, it was viewed as a hardware company. And there were a lot of misunderstandings from those investors where they said, well, okay, they're making the phones, they're making the laptops, the iPads. We get it, but it's a hardware company. And obviously, since then, they have grown what was their main driver of growth, which is all the services and subscriptions on top of that. And that's one example of Apple where people are saying, it's just this company, they just do hardware. And then you fast forward many years and they say, well, the hardware is slowing down. We're not sure if the services will keep going. And therefore, the stock sells off a little bit. And then, by the way, Apple buys back all of its shares. Not all of it. That's an exaggeration. But they buy back a lot of its own shares. So that helps to prop up the stock price every time it declines also. But there's a lot of just misunderstandings over decades, really, of what Apple's doing and what's driving it. And we saw this very recently where they announced some artificial intelligence initiatives in their new phone where it can be helpful as a personal assistant. But prior to that, there was this big concern about, well, Apple isn't innovating. They haven't innovated in a while. They're losing out. Each new phone isn't that big of a new difference, which can be true. But there's this view that, and we've seen this time and time again with Apple, where people are worried because they're not out in front of a trend. But if you step back and look at the history of the company, I don't think I don't want to say ever, but rarely have they been first to do something. When iTunes came out and when the iPhone came out, it was not the first music playing device. It was the best music playing device. They look at what is up and coming, what has someone else started to create, and they might have had some creation process alongside them. So I'm not saying they're always lagging, but what they do best is they take things and they are fantastic at translating that into a user experience. So they don't have to be on the leading edge of everything in order to continue to generate profits and growth all the time. They can focus on what they do best, which is taking technology, developing some new technologies on their own, of course, but then adding that into a user experience that people generally enjoy. So if you're looking to evaluate Apple as an investment, you shouldn't be saying, well, gee, what new amazing fancy thing are they coming up with? It should be more of how are they going to take something, fit it into what they already have, and make it amazing, something that customers want and will enjoy, even if right off the bat they don't even know they want it. A lot of times they discover it, and then everything just is off and running from there. It's interesting to hear, I'll bring up a third example, interesting to hear similar things being discussed with NVIDIA now, where they're obviously doing extremely well. They're selling lots of different chips for artificial intelligence, very sophisticated, very expensive chips. And so the thought is, well, gee, at some point that's going to slow down and the company's going to take a hit, which is absolutely possible. But here's what's being missed. And this is where it's really important to understand the company that you're investing in, because even if you've been investing in NVIDIA and have done really well, it's absolutely valid to be worried about a decline in both the sales and the stock and the demand for the chips. That's all fine. I don't know that it's really going to happen. Could it? Sure. But here's the thing. Even if chip sales decline, we have to understand that there's another piece of the business that's really important. And that is that NVIDIA gets an ongoing payment for services that come along with their hardware. So it's not just they are selling hardware and they say, here you go. They're selling hardware and then a platform and a service on top of that that is ongoing revenue. That is not likely to go away. Companies are not likely to spend hundreds of millions, billions of dollars buying these chips, putting them on this platform, and then saying, nah, we're going to scrap that. So could it happen? Sure, anything's possible. But we have to understand that we have to understand what's driving the company. And certainly the chip sales are driving it, but there's this underlying piece of recurring revenue that is critical to the valuation and to understanding how the company is going to be making money going forward. So there's just a couple of examples. We talked about Disney, Apple, NVIDIA. There's lots more. We could have talked about John Deere and how they're starting to become a little bit more of a technology company. Obviously, they still have the hardware that they sell, hardware being the machines, but they're really going heavily into technology and even some of the consulting, if you want to call it that comes with it. There's so many examples of this where we may think we know about the company, likely because of the history of the company, but the company may have evolved. And we didn't even talk about Amazon. That's a great example. Everybody thinks about Amazon as the shopping website, which is absolutely true. But a ton of their money is made off of Amazon Web Services, which a lot of individual consumers don't really even interact with that at all. But those web services are critical for a lot of infrastructure and what businesses need in order to have the computing power and the distribution services. So even if that's just another great example we didn't even talk about, where it's easy to think of Amazon just in terms of the retail, the online shopping, but there's so much more that they have going on. And really, when I say so much more they have going on, that other stuff drives a heck of a lot of cash flow and is even more important than what they have through their website. So again, a lot of times our view of a company can be skewed partially by history and partially by only the pieces that we see or that we interact with. It's really important to do the homework that we talked about in terms of listening to earnings calls, reviewing the financial statements with the cash flow, balance sheet, income statement. You don't have to be an absolute expert in every single detail, but if you can do those things, you will have a much better understanding of what the company actually does, how they make money, and how they are going to grow and what's going to drive that growth. That way, when you hear a bunch of stories in the news or somebody popping off about the decline in demand for this thing or whatever that the company does, you might be able to say, okay, that's valid, or that doesn't really matter. This is the piece that's important to the business. So just as you're trying to invest in these individual companies, make sure you truly understand what it is they do, what's driving their profits, and what will then drive their growth.